Let's talk about interest-only payments and how they relate to residential mortgages. So a quote, normal mortgage, that's just my air quotes right there. Using a normal mortgage or getting a normal mortgage, it's going to be principal and interest. What does that mean? So if somebody's borrowing a loan for, let's say, 30 years, or getting a 30-year note, let's say it's a fixed rate mortgage, so just plain vanilla mortgage, the payments each month, are typically going to be set up, not typically, will be set up as principal and interest. So what that means is as you pay your mortgage payment, part of that payment is going to be the principal, and the bigger part in the beginning years is going to be the interest. So if a mortgage payment, say $1,000, it wouldn't be uncommon to have $900 go towards interest and only $100 go towards your principal. That is a principal and interest payment. So when you're making your payment each month, as one full $1,000 a month payment in this example, 900 of it goes to interest, which is a lot of money. I get it. And $100 goes to your principal. So over time, every month, and let's say in my example, next month on month 2, maybe $898 goes towards interest, and now $102 goes towards principal. So I'll put somewhere around here, I'll put a link to a worksheet that is a loan amortization, fancy word for payment calculator. But you can see it maps it out for all 30 years or 15 years, or whatever you select in that worksheet. It'll show you month by month what payment breakdown would be for principal and interest. But that's a principal and interest payment. So I know I said interest only, and that's what this is about. The reason why I explained that first is now you need to know what interest only looks like. So at the end of 30 years with a principal and interest payment, that last year, let's say, the numbers get reversed, where $900 goes towards your principal and $100 towards yours. It's just how the amortization works. So now let's talk interest only. Interest only payments are super easy to calculate. They're not, you don't need that payment calculator worksheet I just mentioned. Interest only is you're paying just that, interest only. So in the example I just gave you, and I'll give you use real numbers to help you calculate it in a second, but instead of making the $1,000 a month payment in that example I just gave, now you only make a $850 payment or a $900 payment total, because the payment is just to cover the interest. No more, no less. Now, you can pay extra that goes towards principal, but your actual monthly obligation on an interest-only loan is just the interest that's owed. These are very common with HELOCs, home equity line of credits. We'll put a link somewhere around here for that. So that's common. HELOCs are typically interest onlys. You have to do something extra, but normal mortgages are not normally interest only. There are products like what's called like an all-in-one or commercial loans, things like that, that will also be interest only, but interest only is very easy. So let's just say, for example, and I'm pulling out the trusty calculator, right? The iPhone. So I got my calculator. If somebody owes $100,000 on a mortgage, and let's say they got a 6% interest rate. So I'm going to multiply $100,000 times 0.06, right? Very easy. I'll even do it up here so you can see it, equals $6,000 a year of interest on an interest-only payment, divide by 12, because we're going to make 12 payments. The monthly payment on that 6% note for 100 grand, the interest-only payment is $500. So interest only is super easy to calculate. You just take whatever's owed. So let's say in that example now, somebody won a lotto scratch off, and now the $100,000 loan is $90,000 because they just put down the 10 grand plus the $500 of interest. So now they owe 90 grand. So this very next month, like if it's a HELOC, you got a $90,000 balance times the same, let's just say the interest rate 6%, equals, divided by 12, the next payment on an interest-only loan, the very next month, you paid 500 last month, 500 again, and maybe you threw 10 grand extra. Now, the very next month, the interest is calculated on what's owed. So in this case, $450 payment. So somebody can make a $450 payment for the next 5 years, and their balance stays at $90,000, because until they proactively apply some interest, or pardon me, principal, you're only paying the interest. So it's really important to know that interest only, that balance, you have to proactively go after it, because interest only is going to have that same balance over and over and over. So with interest onlys, they're good for the right folks. If you're just wanting to set it and forget it, I would recommend principal and interest. Most loans, like I said, the normal, air quotes, normal loans are principal and interest. but things like the home equity line of credits or just line of credit in general are interest only. So if you have questions, as always, you're welcome to reach out to the Mortgage Mark team. We are certainly here to help. Forward, share, subscribe, all that fun stuff you know to do. And as always, when you think mortgage, think Mark.